Is the recording started? Oh, now it started. Okay. So Matthew, pleasure again to have you on here, brother. I would just put in the setting that you can share your screen and then you can take it away as you want to, bro.
Yo, what's good? What's going on, guys? How are you,
Not
brother?
much. Hope you're doing well, bro.
Doing well,
tired.
man. Yes, sir.
I'm tired, to be honest, but I'm good. Profits today, so it's a good day today.
What time is it right now? I forget sometimes.
7 p.m. European.
Oh, nice.
So everybody except Bree is from Europe. Most of the people are actually from Netherlands, and Bree tunes in from also same time zone you're on, brother.
Oh, for real? No way.
Around Las Vegas area.
Oh, you're in Vegas? It's dope.
Bree is actually one of the apes as well, so.
Oh, nice.
How we connected.
Yeah. Vegas is cool. I like Vegas.
Yeah.
Yeah,
Let's not go too into detail here. Remember, we're recording. We've got to keep it PG-13, otherwise YouTube might put a block on us.
I mean, bro, I'm a degenerate. I'll be at the tables all day and night. So, yeah, well, let's hop into this. But yeah, what's good, guys? Imagine you're doing well, having an amazing day as always, right? Appreciate your time. You know, time is important, so we're gonna go ahead and hop right into this thing, right? So, let me see here really quick. 1 second. Okay. All right, let me pull up this chat box.
Yeah, we can see your chart. So guys, by the way, whenever you have any questions, either unmute yourself and just ask away or put it in a chat box, because this session really is here. Like Matt takes the time out of his day to help you guys in trading and win in trading.
Yeah, I mean, most of you guys, I see a bunch of familiar people here, what's good. Especially like if you've watched recordings, I know Chris has shared recordings from some of our previous sessions. If you haven't watched those, I'd highly recommend, because you see that it's about just having a process, right? Just like, I guess in math or whatever, you have like orders of operations. It's having a system and following that system. Nothing really changes as far as the approach. You know, yes, you know, there's certain, you know, different market conditions and stuff, but in reality, you're really looking for the same thing. And, you know, our objective is to keep trading as simple, uncomplicated, straightforward, interesting, and as rewarding as possible, right? So when it comes to it, you guys are aware, right? All we're really looking for is accumulation and distribution, right? And it's understanding where you're looking for these things. So yeah, you know, understanding liquidity, you know, again, understanding that most traders, you know, are just in reality, they're trading, you know, double tops and stuff like that, double bottoms. You know, they see trend lines and they're following the trend and buying, you know, at the trend lines, and you know, they're selling every time it taps the trend line and stuff like that. Or they see, you know, a breakout and then they start selling because it broke a low, or they see a breakout to the high, they start buying because it took out a high. And it's understanding all these different retail methods that most traders are trading and really exploiting that, because, you know, it's understanding that, you know, those who control the information, you know, control the world, they control the markets, they control everything. So, you know, if most people are trading these patterns that are out there in the public and stuff, it just makes sense that it's wrong, you know? So when you really dive into it and just observe price action, study, back tests, all of that stuff, in reality, like the best teacher, of course, is live execution in the markets experience. The greatest teacher will always be your own personal experience, right? Because most of trading is understanding how to manage your emotions, right, throughout your trading process. And what helps those emotions, I guess you could say, stay back, is having a plan, first of all, right? Having a specific trading plan that you're actually following. So, like that's kind of where it starts before even understanding what you're looking for to enter, like before entering a trade and stuff. Like, like we understand this, right? Like, I mean, if you don't, we're about to go into it, like understanding accumulation, reaccumulation, distribution, redistribution, and then, type 1, type 2, where it reaccumulates here. Like, nothing really changes. Like, we're going to go into this, but I'm just drawing it because this is all we're looking for. Accumulation, distribution, like this is exactly how I see the markets. This is, I enter here, I enter here, I enter. We'll get into that. But before like understanding any of that, like if you do not have a system set up, a solid foundation, then none of that matters, right? Taking a trade, none of that matters, because you need to first understand, okay, what assets do I trade? And you need to stick to those assets, right? Can't be jumping around. Like I know you see on here, like I have all these assets. It's because people ask me to look at them all the time. So these are like the general assets that are on here, but I'm only trading the indices. Like that's all I trade. I don't trade anything else. So like you got to have, I'm not telling you to only trade a specific asset or to only trade the indices or to only trade certain things, but I'd say 3 to 5 assets is like a max of where it is, because if you really think of it, there's so many opportunities that are taking place, especially throughout said session, whether it's the London session or the New York session, whatever it is, the way I like to see it is you don't want to, so the first objective in trading is capital preservation, right? The second one is capital growth. So first is preserving your capital. So why do I like to trade the indices? Because for me, they're just the cleanest with price action in the way we trade. They're volatile, so they move quicker around the certain time window. It's consistent. So for me, I only trade around the New York Open. So after 9:30 a.m. Eastern, that's the only window I trade. Like I'm only on the charts for like an hour max. So for me, it's like that's my window. So that's why I like trading the indices, because the market opens at 9:30 and it's, there's a nice impulsive move with volatility. You're in and you're out. I'm an in and out trader throughout the same day. Like I'm intraday trading, right? Yes, we swing and hold certain positions long term, but for the most part, you're paying yourself daily. Like that's, day trading. So, so that's why, to answer your question. Yeah, so it's really understanding the assets that you trade. So it's like, okay, for me, right, I only trade Nas, Dow, and S&P. Like that's all I trade. So if for you, if it's EU, GU, and UCAD, or EU, GU, and gold, well, then that's all you trade, right? Stay within those parameters and discipline yourself. You don't want to spread yourself too thin because you're like, oh, there's an opportunity here. Oh, there's an opportunity there. There's opportunities all over the place. All right. It's just understanding, being able to be disciplined and stay focused on your assets, right? It's kind of like, would you rather have 3 super high, okay, so this is for like the bachelors out there, right? So would you rather have like 3 super high quality, like people that you're like communicating with, maybe like you're dating them or whatever, right? Or would you rather just have a fuck ton of people that are just not the highest quality people and you're just out here messing around? The risk to reward is not really there. I don't know, you might catch something. Anyways, so here, I know Chris said keep it PG-13, but you can't even trade if you're 13. So I mean you can, but we won't talk about that. So yeah, my little brother has been learning how to trade since he was 11. He's 15 now. But yeah, anybody could do it. It doesn't matter what age you are. But anyways, like that's something like you got to see it that way. It's like, would you rather focus on a bunch of different things at once, or a couple things that like the back of your hand? You have a good relationship with them, like you understand where it was yesterday, because if you're trying to trade all these different assets and you're trying to remember where EU is or where it was yesterday, like you're not going to have an idea of what happened last. So that's why I believe the first thing is picking your assets that you're going to study, that you're going to follow up with, every single day, that you're going to trade every week, all of those things. So the first thing is understanding what assets you trade, and then setting your trading window, right? You got to have a specific trading window. And again, it's one thing to develop these systems and these plans, but it's another thing to follow it, right? Like discipline is really being able to tell yourself to do something and do it, which I'm sure, everybody here is pretty disciplined. So it's developing that. So having the assets you trade and then having the specific window. So if you tell yourself, oh, I only trade from this time to this time, you better only trade from this time to this time, right? Like this is the business. You have to treat it like a business so it could pay you like one. If you tell yourself, oh, I only trade from this time to this time, that's what it has to be. So for me, I only trade, after the New York Open, literally from around, I was at 6 a.m. my time to like 7:30. So literally like an hour and a half on the charts. Outside of that, I'm not trading. So like that's just what it is. So you have to have the assets you trade, the time window, and the specific amount of risk you're using per trade. So for me, I'm literally risking 0.2% each trade. Again, maybe you're doing 0.5, maybe you're doing 1% if you're trading your own capital, but like ideally, if you're trading funded accounts, you don't want to be, again, like not a financial advisor, but you want to stay around the 0.5% and below mark if you're trading funded accounts. Like you just want to be very conservative, right? You want to preserve that account and you want to grow it. If you're out here risking 1-2%, like 2 to 3 trades, your account's fucked in a day. So
How do
like,
you
you want to put yourself in that position.
how do you see like scaling down? Let's say, okay, so that's how I did it. To have more trades in that account, because that's initially like our goal, right? To have as many trades as possible within an account so that we have a chance to pull it up, or if it's down already, get it up again. How do you see it with, let's say you start doing the first percent of your account or first couple percent, 0.5% risk per trade, and then go down to 0.25, the last, let's say 2%, 3% of that funded account, for example?
Yeah, so for me, I would start off at around 0.2% risk. Like that's where you want to really ideally be around, because if you really think about it, for you to go 1% in drawdown, like you got to lose 5 trades in a day. And in reality, you shouldn't be taking more than 5 trades in a day. Like that just shouldn't be happening. Like the number one reason why most traders fail and they lose their funded accounts and all this stuff is because 1, they're over trading, and 2, they're over leveraging, obviously. So I believe, that's really the key is really starting there, because then you won't really be in that position. For you to lose 2%, you got to lose 10 trades in a row, and you got to really evaluate that. So in order for you to lose the account totally, you got to lose, 25. So, and that's in a day. So that's 25 trades in a day. Consecutive losses like that just shouldn't happen. Like there's no way that should happen. And again, if it does, I mean, obviously you understand why. It's because you're just gambling and you're over trading, and that's you got to really just be aware of that, like right when it happens. You got to have parameters, and you got to set those parameters for yourself. So understanding what assets you trade, what time window you trade in, the amount of risk you risk per trade, and the minimum risk to reward that you're going for. So you guys know, for me, it's a minimum of a 1 to 3. So if I'm risking 0.2%, I'm going for 0.6, so you got to have a minimum risk to reward. And if the trade's not there, then there's no trade. If the target isn't a minimum of 1 to 3, then there's no trade. Maybe for you, it's a 1 to 2, right? I'm just sharing what it is for me. So like, and the reason why it's a 1 to 3 for me is because you could lose 70-80% of the time and still be profitable. That's the power of risk to reward. So what assets you trade, the time window, the amount of risk you're using per trade, and then the minimum risk to reward that you're going for. Like this is the foundation before understanding what you're looking for in price action. Like if you can't follow these specific rules for yourself, nothing matters. So other thing is your risk parameters, right? Or the amount of trades you're taking per day. So you have to have a parameter for the amount of trades you take per day. You really shouldn't be taking any more than 3 to 5 trades in a day. Like honestly, like if you're taking more than that, like you're just overexposing yourself to the market, right? So you want to I'd say around 3 to 5 trades a day max. There's days where I just take one trade and that's it. There's days where there's no trades, and that's cool. But really 5 trades is like, it's a lot of trades, right? So 3 trades in a day, I use that for a really long time, and it worked very well because for me it's like 3 strikes, like, and if I only have 3 shots, 3 bullets in my sniper, then it's like I got to make them count. If I take a shot that's just not a high quality shot, then I'm fucked and I'm exposing my position. I'm giving up my, a sniper is like in the bush, in the trees, whatever. So if you use that bullet, like, and it's a terrible shot, then you're exposing yourself to the market and you're giving up your position, right? So that's the way I see it, is being very like preserving capital is first. And then when like it's there, it's like when we get into like what we're looking for, it's like you're only executing when you see it. And if it's not there, there's no trade. Like if you don't see the evidence of accumulation with reaccumulation, there's no trade. If you see it, you execute without, hesitation. And same thing with distribution, right? So the assets you trade, the time window you're trading in, the amount of risk you're using per trade, minimum risk to reward, and your trade parameters, like how the max amount of trades you allow yourself to take in a single day, because then that'll allow you to cherry pick higher quality opportunities. So if you have 10, 20 trades in a day, you might take 10, 20 trades. But again, if you really are just patient and you allow price to develop until that opportunity presents itself, then you'll go ahead and pull the trigger. So there's no trade until it shows itself. And of course, you can have certain parameters in a day. Like, again, that's why the 3 to 5 trade thing is there, because it doesn't matter whether you win or lose. It's like those are your parameters, right? So maybe you have, okay, if I hit 1% loss in a day, I'm done. If I hit 1% profit in a day, I'm done. That's pretty much my thing. Is if I hit 1% loss in a day, I mean that's 5 trades, I'm done, right? I hit 1% profit in a day, I'm done. So that's my thing. It's like 1% a day type thing is like what we're really going for. So yeah, so that's like the foundation before getting into price action and everything. You need to have those parameters, and if you don't, I'm happy that we're talking about this so that you can. But yeah, so and then when it comes to paying yourself and stuff, going break even, because there's different steps throughout the trade, right? There's the approach, which is like before you even come onto the charts, like where are you? Like what's your mindset? What's your energy? Like how are you before even coming onto the charts? Like that's key, that's super key, is that your mental state and all of that. So the approach is the first thing, and then your analysis stage, like you're analyzing the markets, and then you're planning the trade, which is like you're anticipating something, and then when it presents itself, you're executing the trade, and then when you execute the trade, you're managing the trade, and then you're exiting the trade, and you're journaling the trade, and then you're moving on from the trade, and you're preparing yourself for whatever opportunity presents itself next. So it's first the approach, the analysis stage, planning the trade, executing the trade, managing the trade, exiting the trade, journaling the trade, moving on from the trade, which is very key, because if you hold on to the previous trade, so you're just living in the past, maybe the trade didn't go your way, you're going to carry that into the next trade. It doesn't matter no more. It's in the past, right? So even if it's a win, like, you can't, like, it's a whole new situation now. Like, you're only as good as your next trade, right? So, and then, yeah, preparing yourself for whatever opportunities present themselves. So, of course, when it comes to the approach, whatever kind of routine you have, everyone has different routines. I'll be honest, a lot of times these days, I just fucking wake up and get on the charts. I've done a lot of different things where it's like, like I go outside, I touch grass. I love grounding myself. It's very powerful. Breathing exercises, meditation, all that stuff's very powerful. I do a lot of it as well. But there's just days where I stay up late and then I wake up early But definitely after the charts, like I do that stuff still. But whether you work out before or after, or you read, or like whatever it is, being in that calm state, because a lot of traders will have anxiety when they're trading because they don't want to lose, or like, whenever you're in the trade, you're fucking shaking, I don't know. That's very normal for people to experience things like that. And the way to get rid of anxiety and stuff in trading, or to help minimize it, is to reduce your risk, right? Maybe you're risking too much in a trade if you're feeling that way. The goal is to compound your account, not really to flip it. Those 1 to 3s over time, like that's what compounds your account. That's what grows it over time. That's what gets it to the flip, is all of those 1 to 3s adding up, all of those 1 to 5s, all of that. Like that's the game that we're in. And the reason why most traders have the mindset of like, oh, I need to flip my account, I need to make this much money, they're thinking in terms of money, dollar amounts instead of percentages, is because their trading account isn't big enough. And that's why we encourage traders to use funded accounts, because if you've never traded 100K and you've never made $1,000 in a day, like your life's going to change when you start doing that. You're not going to feel like, oh, I need to risk 1%, 2%, or you're not focused on the dollar amounts. Now you're focused on percentages, because you understand, okay, if I do 1% on a 100K account, like that's $1,000 in a day. A 200K account, you're having 2K days. A 300K, you're having 3K days. You get up to $1 million plus. Like there's no limits. So thinking in terms of percentages, even when you're trading $100 account, a $500 account, $1,000 account, like you continuously want to think in terms of percentages, because if you just keep looking at the dollar amount, like I truly believe that's a limiting thing. Like, oh, I made $500 today. Well, it's like you're not aware of the percentages, because maybe that's 5% on an account, that could be 5K on this account. So thinking in terms of percentages is just the way professional traders think, and it's very powerful. Another thing is trading on your phone. If you're trading on your phone, like that's one thing. We don't really trade on our phone. A lot of us, like, we trade on our desktop. So like if you don't trade on your desktop, if you're not using a position size calculator, I would highly recommend it. A lot of times, like you want your trading process to be as smooth as possible, right? Especially when you're executing. Like how many times have you, like, oh, I got to calculate my lot size and then I'm going to enter the trade and the trade's fucking gone, right? So it's like, we have software that we use on our desktop that literally calculates all of that for us. You never have to waste a millisecond even thinking about what lot size to drop, where your 1 to 3 is at, entering your stop loss and your take profit manually. So I know some people on here have the position size calculator. If you want to drop it in the chat, if you can, please. If not, I could share it after this, or I'll have Chris share it with you guys. Okay, yeah, Mitch, if you want to share, that'd be awesome. But yeah, because with this position size calculator, you have a hotkey. So for me, like my hotkey is Q. So I press Q and it enters the trade, it puts my stop loss and it puts my take profit, and it uses consistent risk. So every trade I take, it's automatically doing 0.2% risk. My stop loss, if I lose it, it's, yeah, you can set the hotkey to whatever you want. If you hit your stop loss, you're losing 0.2%. Take profit at 1 to 3 automatically pays yourself at 0.6% profit, right? That's just an example. So the position size calculator is powerful. You could even set it to where it doesn't allow you to have a certain amount of positions open at the same time. So if it's no more than 3 positions, it won't let you have more than 3 positions open at the same time. So like that's a very powerful tool, again, to go along with your system, with your foundation, because it'll allow you to be disciplined and it'll allow you to execute more efficiently without having to waste time thinking about what lot size to drop, and you'll be accurate with your percentages, your risk to reward and all of that. So that's something, if you don't have it, I'd highly recommend to start using, because again, this is all before any type of price action, right? Like understanding price action, the nature of price action is a whole nother thing, but this foundation is everything. Like you can only go as far up as deep as you really set that foundation down. So yeah, so those are just like a couple of things. But yeah, let's get into like understanding price action, because it's really, like I said, the objective is to keep it as simple as possible, right? So we understand bearish trends, right, are creating lower lows, lower highs, lower lows, and lower highs. So again, lower low, lower high, lower low, lower high, lower low, lower high, lower low. That's what it is, right? Vice versa, bullish trend, creating higher highs and higher lows, right? Higher high, higher low, higher high, higher low, higher high, higher low, higher high. Cool. So it's important to understand, of course, whenever the market shifts, you know, like things like this, you know, when it goes up and then it goes down, like what's happening. So you can see here in a bullish trend, it's creating higher highs and higher lows, creates a new high, closes below that previous higher low, and then it starts to create lower lows and lower highs. Just like you see here. Look at this. Higher high, higher low, higher high, higher low, higher high, higher low, higher high. We close below. What do? We came back, and now we start creating a bearish trend. So it's that simple. Like that's all we're looking for, is that, you know, you want to look for that. And of course, you know, we'll get into redistribution, which is in here, where it does it again on a smaller time frame. This is where we really execute, you know, take it to the downside. So you're looking in here for it to happen again on a smaller time frame, and then you're getting in and you're shorting, right? So vice versa, it's the same thing, right, in the opposite direction. So this is type 1. So that's type 1 distribution. Now this is accumulation here, right? Whenever it's coming in a bearish trend, creating lower lows and lower highs, closes above that previous lower high, you know, that's showing willingness for price to trade higher. It was in a bearish trend. Now it's creating higher highs and higher lows. So you see over here, lower low, lower high, lower low, closed above. What did it do? It came back, and then now it's just continuing to the upside. So those are the ideal trades you want to be a part of. Like, yes, there's tons of opportunities in here. We won't really get into that right now, but it's understanding how to play the continuation of the trend. So this is really type 1 accumulation, right? Whenever you see price coming down to a super low point, bearish, break structure, comes back and it starts accumulating to the other side. And in here, you're looking for that same thing, which we'll get into. This is reaccumulation, okay? So, so that's the first thing, is understanding that. Now, again, accumulation is type 1 accumulation is when it creates lower low, lower high, lower low, right? It takes out this low and trades to the opposite direction. Now, it's important to understand like what's going on here. So at the end of the day, it doesn't matter. Like, you know, we understand the biggest participants in the markets are the major banks, but it's important to understand that it doesn't matter how much one entity or one person is buying or selling. Nobody's like moving the markets with their money. Price is being delivered by an artificial intelligence. So price is moving based off of AI. It's programmed. There's an algorithm, and it's just moving. Price is delivering based off of that. And it's liquidity engineered, which means, of course, there's money all over the place here. And, you know, it's understanding where the money is, and that's where the market moves, is wherever the money's at, right? So here, understanding this, lower low, lower high, lower low, boom, there's your breaker structure, right? So this is showing accumulation. Now, we like to put a story behind price action just to help understand and make it as simple as possible to see and understand what's happening. As you see, low, lower high, lower low. So imagine how many people are buying at this low, you know, praying that it's going to go up, and they have their stop loss below this low. Vice versa, how many people are selling, you know, because it's been selling off, and they have their stop loss above this high. Now, the markets are going to move in the direction to hurt the most amount of people, right? The markets weren't just designed so anybody could come in and just make a bunch of money and get super rich. Like, that's just kind of the reality of it. So here, understanding this little impulsive move to the upside, okay, it's still bearish, low, lower, high. So many people are buying here early, thinking price is just going to blast off, and they have their stop loss below this low. Vice versa, price has been selling off, so people are going to sell with their stop loss above this high. Well, these are early buyers these are late sellers. Also, a buyer's stop loss is a sell stop, because there's traders who also believe that whenever price goes below this low, it's just going to keep selling off. So they have sell stops below this low. So it activates their sell stops in that direction, right? So there's early buyers, late sellers, right? So imagine you're the one that's moving the markets, Paul. If your objective, if your agenda is to take price to the upside, what you would do, right? You would use liquidity as fuel to drive your position. So you would sell, let's say, 500 billion to the downside to take out early sellers, or to take out early buyers and to induce late sellers. And then you would buy 800 billion to the upside, okay? And now you took out early buyers and you took out late sellers. So you wiped the board. What you did, you took them on both sides, okay? So here, now there's a lot of confusion, right? Now, with an impulsive move like this, how many people do you think are chasing this? Like, oh, I'm gonna buy, and they're buying at the highs, right? Like that's just what most people do. Okay, and they see a little reaction, they're like, oh, sell, sell, sell. Like that's just what most people do. So here, your sells are in drawdown, right? You sold 500 billion, you bought 800 billion. So your sells are in drawdown, but your buys are in profit. So if your objective and your agenda is to continue taking price to the upside, what would you want to do? Someone could tell me. All right. You would want to at least do what? Exactly. Yeah. So you would at least want to sell down into here to break even on your sells so that you can add on to your buys. All right. So you would sell to buy, and then you would sell to close your sells, your previous sells, and then add on to buys. All right. And then same thing here. This push down here, you would add on to sells to close them and then add on to buys. So this is how the large players are hedging in the markets. They're sacrificing capital short term for long-term gains. They're investing. That's what they're doing, right? You're sacrificing these shorts for long-term gains. So, you know, they may have some positions in drawdown, but they're always in profit, right? So that's exactly what they're doing. So here, like, so this is exactly how the algorithms work. How, you know, large institutions are mostly trading with AI technology, like that's just really what's happening. And if you have AI technology, you know, that does very well. We won't talk about that, but you'll notice it does exactly this. There's positions in drawdown, but it's always in profit. So here, this is really the model. Like this is the signature trade, as you could call it, because what's happening here is sell to buy. Now, what you want to see is exactly this, right? You want to see, in this case, if you're looking for buys, you want to see a low get taken significantly, liquidity gets swept. You want to see an impulsive move in the opposite direction that leaves behind imbalance, right? So you want to see a significant low get liquidity swept with an impulsive move into the opposite direction that breaks structure that leaves behind imbalance. And this is where we get in for the buys. Stop loss below this low, target a new high. Again, this is accumulation, type 1 accumulation. And then here, again, since the markets are fractal, right? Let's define fractal really quick, right? So fractal is a curve or a geometric figure, each part of which has the same statistical character as the whole. Fractals are useful in modeling structures such as eroded coastlines or snowflakes, in which similar patterns recur at progressively smaller scales, right? And in describing partly random or chaotic phenomena, such as trading account growth, fluid turbulence, galaxy formation, right? All that good stuff. So it said crystal formation, by the way. They didn't say trading account, but growth. But it helps. So here, understanding this retracement, since it's fractal, since this was coming in a bearish trend and it accumulated, if we're anticipating price to do the same thing, that means this on a smaller time frame is coming down in a bearish counter trend. It's coming in a bearish trend. So we would be on here anticipating this area, anticipating price to trade into this area in that bearish trend. And in here, we would wait for price to show us evidence of reaccumulation, right? So once this happens, this is showing the similar characteristics. This is more evidence that price is accumulating and wants to continue trading to the upside. When it comes into a previous area of accumulation and does the same exact thing, this is your indication that price wants to trade higher. So this is where we execute. This is where we get in. You can put your stop below this low, which happens here, or you can put it below the original low, and you're targeting a new high, right? Like this is type 1 accumulation, and it's the same exact thing on the other side for distribution when you're looking for sells, right? You know, as above, so below, all that good stuff. It's just how it is. So here, you know, high, higher low, higher high. Now imagine how many buyers are chasing this uptrend. They're buying. How many people are selling at this high because it gave a reaction, right? So again, late buyers, early sellers. Imagine you want to take it to the downside because we're waiting for this evidence, right? We're not guessing. We're waiting for evidence to be presented to us, and then that's where we're getting in. So here, imagine again, early sellers, late buyers. Imagine you buy 500 billion contracts to the upside to take out early sellers to induce late buyers who believe once price goes above this high, it's going to keep going to the upside. You're taking out early sellers, taking out late buyers. You're buying 500 billion to the upside, selling 800 billion to the downside. Now, what's happening here? Your sells are in profit, but your buys are in drawdown. So if your overall objective is to take price to the downside, what you would do is you would, you'd want to buy back up into this area to close your previous buy positions to add on to your shorts, to add on to your sells. So that's exactly what's happening. This is called mitigation, right? You're mitigating. You're moving in and out of positions. You're reducing your risk. So here, this is your mitigation where price comes back to close these buy orders and add on to sells. So again, when price is retracing back into this area, again, what you want to look at is you want to see that significant move up, that swept liquidity before breaking structure, that creating that impulsive move to the downside that left behind imbalance. And you want to wait for price to retrace into that imbalance. And that's where we're looking to short. That's where we're looking to execute. That's where you could wait for this bullish counter trend that's coming in a bullish retracement here. You want to wait for that evidence of redistribution, because again, this is distribution and this is redistribution, right? Right here. It's fractal. So you want to wait for the evidence of redistribution, and that's where we sell. That's where we get in, stop above the high, we target a new low. Like this is the signature trade before, catching type 2 accumulation and distribution and, all these other things. It's understanding this one first. Like this is the first thing, right? This is what I just showed you is 2 of the 6, like really entry models, right? Like this is type 1 accumulation. This is type 2 type 1 distribution. So, and I just showed you exactly that here. Like notice, right? It broke structure. It came back into this area, right? And then what did it do right here? Distribute it again, execute, just keep going. This is the higher time frame, of course. You got to understand on a higher time frame before anything. Like before we get in, because you guys know, like, if you hop on the sessions and stuff, like, we're taking entries on the 1 minute, the 15-second, like all that stuff. But it's like you got to understand it on a higher time frame before any of that. You got to understand how, because it's fractal. Because what happens here, what it looks like on the weekly, like the same thing is happening on the 5 minute, on the 15-minute, on all of that stuff. But it's understanding the price action. So the whole story hit in and became logical at once. That's cool. Yeah, so here, so that's that. Now let me show you type 2, okay? So type 2 accumulation is when price is coming in a bearish trend. First of all, any questions or comments, anything before we go ahead and continue this? If that made sense, drop some 8s. I just want to make sure. I'm sure a lot of you are familiar with this already. It's rinse and repeat is the motto. Like sometimes the market will retrace to the imbalance. Yeah, because a lot of times it'll do this. That's another thing. But yeah, a lot of times it won't retrace into that imbalance. I mean, look at this, right? I mean, it barely tapped into it, or a lot of times it barely will. But yeah, it's very true. Like it's not always. Do you look for accumulation distribution on the higher time frame? Also, yes, always. Yeah, definitely the higher time frame helps because that's really where you want to start. You want to start on the higher time frame and work itself down. What is the psychology behind that? I mean, that's just the market's not wanting to come to that imbalance. I don't really know what else to say. It's just how it is, you know, like the market doesn't care what we want or what we're waiting for, you know. It's like the market's going to do what it's going to do. It's just like we got to see what it's doing in that moment. And if it's in an area that's significant and it's showing us that evidence, then that's where we execute. If it's not in one of those areas, then all we do is wait. Like, yes, you know, a lot of people's like, oh, professional traders, but like we're really professional waiters at the end of the day. Like we're waiting for a long time before price, you know, actually shows that. Because again, if it's not there, if it's not showing you exactly what I just drew, then there is no fucking trade to be taken. Like there's just no trade, right? So the same thing is here, right? We won't go into continuation. Well, I'll do this. Whenever the market's bullish, comes into a previous area of accumulation, it's retracing in a bearish trend. And yeah, that's your evidence of reaccumulation. You see higher high, higher low, some imbalance, swept liquidity, broke structure. Boom. You know, that's your evidence of reaccumulation. You could get in, stop below the low, and target that high. Like that's continuing in the bullish trend. And this is continuing in the bearish trend. When it's lower low, lower high, retraces back into this previous area of distribution that hasn't been mitigated out of, that left behind imbalance. And then it's retracing in a bullish trend. And then once you see the evidence of distribution and redistribution, you get in for shorts and you target at a new low. So that's the continuation with type 1. So that's what that is. You know, it's the simplest when it's in trending markets, right? So here, do you use the fib tool when you execute a trade? Yes, that is very key. For me, I just got to make sure we're in 50% of the range. So for example, if I'm measuring from this high to this low, what you want to do, I'm glad you brought that up, bro. So let's see. So this is how I see the markets, right? This is accumulation and this is distribution. In the middle of this is 50%. Below 50%, you want to look for accumulation. You want to look for long opportunities. Above 50%, you want to look for shorts. So that's my thing that's the price range, right? So if this is bearish, you know, or if this is bullish, right, from this low to this high, I want to wait for at least 50% or below to show evidence of reaccumulation before I go long. You know, vice versa, if this is bearish, lower low, lower high, I want to wait for it to come above 50% to show me evidence of distribution before I go short, right? So yeah, I'm glad you asked about that, bro. Yeah, 50% at least. And I can show you an example of a trade that we took today that was exactly that. Do you have structured weekly live analysis sessions that we can join sometimes? I'll let Chris talk about that. But let's continue with this right here. How can you easily train your eyes to see ranges? The body of the candle close. So for me, it's the body of the candles. So notice this higher high, higher low, higher high. Notice how it closed below. And then it created this low. And so this is that last high. So this is your current range, lower low, lower high, close below, retrace, lower low. So now this is your lower high. Notice how it came back, redistributed, created a new lower low. Now this is your last lower high. Notice how it came back, swept that high, but respected it structure-wise, and it continued to the downside. So you see it, right? So yeah, the line chart will help because the line chart is based off of the bodies of the candles. But yeah, same thing here. Higher high, higher low, higher high. Look at this imbalance it came into, reaccumulated, created a new high. So then this became the previous higher low. Look, it came in right into there, respected it, created a new high. So now this is your higher low, and then it retraced, and it just, so the body of the candles is what helps with structure and stuff. But understanding liquidity is far more important than structure, is what you'll see. Because notice this major low right here. We look for major lows to get swept, major highs to get swept. And look at over here, actually, on this, like, look at this imbalance over here. Notice this huge push up that broke structure that left behind imbalance. We didn't return over here for for 20 years, right? 21 years. Then we came back into this imbalance. So it's the same thing on a higher time frame as a smaller time frame. But notice we came into this imbalance. Give me 1 second really quick.
I hope you guys are having a good session here and taking pen and paper out and write down a lot, because it's important to write things down, to memorize things. Recording will be uploaded later. Just gotta hop off in a little bit on the next call. So I'm gonna ask him to wrap it up in a couple minutes here.
We ain't wrapping shit up, bro. We're gonna be here all fucking day and night. Just kidding. I know you guys got stuff to do. Let me go over type 2 really quick. So type 2, right? Again, you want to look for distribution above highs, accumulation below lows. Look at this major low that got swept. What's below this low? A bunch of buyers stop losses, and there's sellers sell stops, right? Who believe whenever a price goes below this low, it's gonna drop. Now there's this huge imbalance right here. So notice how this low got swept and there's imbalance. You want to look for accumulation below major lows. So notice how price traded below this low and then it just blasted off to the upside. And you're like, oh, how can I anticipate price to trade that high if this is lower low and this is lower high? Don't I need a break of structure before buying? No, right? It's understanding liquidity. So here is your type 2 accumulation, right? Whenever price is trading in a bearish range, lower low, lower high, it sweeps a low, creates an impulsive move in the opposite direction after sweeping a low, and leaves behind imbalance. Price comes back and then it flies, right? This is type 2 accumulation, right? And for me, what I wait for, again, after that liquidity sweep, after it creates an impulsive move in the opposite direction and leaves behind imbalance, we're waiting for price to retrace into here. And if it shows you evidence of reaccumulation, that is where we execute, right? So this is type 2 accumulation, where it doesn't break structure, but it sweeps liquidity, it sweeps a significant low, it creates an impulsive move in the opposite direction, it leaves behind imbalance, and it reaccumulates within that imbalance. That, for me, is showing unwillingness for price to trade lower. Price wants to go higher because it's showing you a failure to create a new low by reaccumulating within that imbalance. And notice what's up here. Seller stop losses, right? So many people chasing this sell. So it's understanding liquidity. So here, that's type 1, or this is type 2. Look at this, lower low, lower high, lower low. We took out this major low. What do we do? Left behind imbalance. Ooh, blast off, right? Now, again, you can go into here, and what do you see? Price tapped into it, lower low, lower high, lower low, reaccumulated right there, blasted off. And on the smaller time frame, yes, it did break structure on the daily, created that imbalance, but again, tapped into the imbalance, reaccumulated, and it just continued in that bullish trend. So So that's that with type 2. And then we'll do it inverted on the other side. Right, notice we took out this major high over here. After that high got swept, high, higher low, higher high. We swept that high, created an impulsive move in the opposite direction, left behind imbalance, came back into that imbalance. We ended up distributing and continuing to the downside. So that's your type 2 distribution, where it sweeps a high. It doesn't break structure, but there's tons of liquidity to the downside here. It leaves behind imbalance after sweeping the high, creating that impulsive move, comes into that imbalance, redistributes within it, showing an unwillingness for price to trade higher, and it continues to the downside. So that is that. We're gonna wrap this up right now. I know Chris has another call to hop on here, probably like in 4 minutes. So let me show you the NASDAQ short that took today.
Oh, you can go over my trade too if you want to.
So notice this major high that we swept over here. All right, so notice this trend. We're pretty bearish. All right, current range here is bullish, this low and this high. So from this low to this high, we're above 50%, right? And there's imbalance right here. So this is an ideal target if you're shorting, okay? We swept this high, we traded into this imbalance. So we're looking for distribution above the high. What happened? Higher high, higher low, higher high. There's your break of structure, right? That's your type 1 distribution. And what happened in here? I swept these highs, right? Didn't break structure, created this imbalance right here. Notice how it swept this high, created this imbalance. There's this huge trend line right here. People are buying this, chasing this thing. Stop losses all over the place down there. And here, right, we came into this imbalance. Notice what happened when we came to this imbalance. We came into this imbalance and then we redistributed here, right? So notice we broke structure, we retraced in a bullish trend into this imbalance. So we're anticipating evidence of redistribution or reaccumulation. Someone tell me in the chat. Distribution, look at that. Boom, there's your distribution there. Price came back. All right, imbalance. There's your redistribution again. All right, so this is how you could get those risk to reward plays. You know, entry here, stop above that high, targeting a new low. I mean, like, you know, you could really just play it like this, target a new low. Cool, you know, it's a 1 to 5. Obviously, if you held it, I mean, you know, that thing is going. But let's go over today's trade, right? Enough about the past. Let's go over today. So here we understand what we're above 50% still, and we have this low. That's a beautiful target, right? What's below this low? Buyer stop losses, sell stops. You have this imbalance, beautiful target, right? So we're bearish. How do we know we're bearish? We see the current range that we're trading in. We see that we had this low, this high. What do? Tapped into that imbalance, redistributed, created a new low right here. So this is our current range on the daily. Lower low, lower high. Cool, we're bearish. So yesterday, or early in this week, we were looking for longs into this imbalance for potential shorts. Lower low, lower high. Again, measure from this high to this low. We're looking above 50% for potential distribution. Notice we came into this imbalance here and we just sold off, right? Now, again, what do we see here? We see price created high, higher low, higher high. Look at the line chart. High, higher low, higher high. This is evidence of what? If we're overall bearish, right? This is literally what we just drew. That's right. That's evidence of redistribution right there. So we're looking for shorts. We got the redistribution here. So we're anticipating price to retrace into this area to show us more and more evidence of what? What?
Distribution.
Yes, sir, my boy Mitchell. Let's go. All right, so redistribution, higher high, higher low, higher high. So we redistributed here, and this is our current range. Look at this is our current range, right? From this low, this high, to this low. What do? We swept these relatively equal highs. Look at these equal highs. They got clapped, right? Look at the penguin right here. He's just chilling. He got smacked. So here, there's seller stop losses and there's buy stops. So what happened? That got poked. So imagine this is you buying, right? Buying 500 billion to the upside, selling 800 billion to the downside. So if we're going to continue to take it to the downside and we're overall bearish, what are we going to do? Right? We're going to retrace to close these open buy positions and add on to sells. So what do we have in here? You have that entire push up. You have this imbalance that exists right here. Again, you look at this range from this high to this low, you were looking above 50% for potential evidence of redistribution. Prices retracing in a bullish counter trend. What do we see? Higher high, higher low, higher high, higher low, higher high. Here, it's evidence of redistribution. Look at that. Distributed right there. You could enter here. Stop loss right above that high, and you're targeting a new low. Boom. 1 to 8, right? So for me, I was asleep when this happened, right? This is around 3:50 a.m. my time. So I didn't catch that. Okay, but I understand we're bearish. So we're anticipating more shorts, more selling opportunities. So here we looked at was this during the New York session. We got some accumulation here, but we understand we're bearish. So since we understand we're bearish, we see this imbalance here, imbalance up here. This is the current range, right? Notice this range, low, high. So here I was looking, okay, from this low to this high, was anticipating up here to get some shorts, but then it created a new range. Look at the candle close. We created this low and this high. So once we swept this high, from this high to this low now, we're above 50%. And we're within some imbalance, and we understand we're overall bearish. So we're anticipating more and more evidence of redistribution. So what happened once we traded above this high? And this is key, right? You don't want to get trapped in, oh, break a structure, you're going to wait for the buy and see something like that. No, right? You got to understand the higher time frame is bearish, or else you'll get caught up in this, seeing, oh, break a structure, boom. You got to understand the higher time frame, because you'll see this is just distribution above a high. So this is the other one. And then it's the same thing on the other way, where it sweeps a low and then accumulates and then continues to the upside. So here was this, what we played, because we understand we're bearish overall. So we swept this high. So above this high, we're looking for distribution. And what do we get? Beautiful type 2 distribution. We swept liquidity. We left behind imbalance, right? We came back, broke structure. So we created a new range, lower low, lower high, lower low. Literally just executed here, right? Stop loss above this high, and overall targeting a new low. So that went for about a 1 to 3, and then it went for about a 1 to 5, and then that was it. So that was today's trade. Like that was today's trade. And yeah, but yeah, I know we've been here for a little while, so it's been an hour, so we're right on schedule. 4 minutes left.
Yes, sir. All good, bro. I appreciate your time as always. As you know, guys, drop some 888s chat for your brother Math. It's always a pleasure to have you on, and I know this is one of many calls and value that we're going to provide for others. So I appreciate your time, bro.
Yes, sir. Anytime. You guys have, enjoy the rest of your week, and yeah, just let me know if you need anything, bro. Always here. Love you.
Yes, sir. I will let you know. Thank you, guys.
Peace, guys.
I will drop the recording on the YouTube, and I wish you all fine Abend, and thank you for the tijd. Ciao, ciao, guys.